Financial ratios sound familiar? Whether you're running an SME or just starting your entrepreneurial journey, understanding and using ratios can transform how you manage your business. Hello, I'm Audrey Beauchemin, manager of the Entrepreneurship Center at BDC. I've been helping entrepreneurs understand their numbers for 15 years so they can make informed decisions. Ready to boost your performance? Let's dive in. As an entrepreneur, it's essential to track your business performance using real data. Monitoring those numbers help you keep an eye on results, anticipate trends, and make informed decisions. Key performance indicators, also called KPIs, and financial ratios complement each other and together reflect your company's overall health. Both are indicators, but they serve different purposes. KPIs measure your strategic objectives. Financial ratios, as the name suggests, are based on your financial statements. They measure your business financial health. Ratios allow you to compare different aspects of your performance, see where you stand in your industry, and quickly identify areas for improvement. They also provide highly essential information. For example, they can tell you if you've taken on too much debt, build up excess inventory, or taking too long to collect accounts receivable. Banks and investors rely on them to assess your business, and you should monitor them regularly. When you apply for financing, you need to be ready to confidently answer your banker's question about your key financial ratios. We have a comprehensive ebook on this topic that goes deeper into today's concepts. Download it now at bdc.ca. The link is in the description box below. Even though there are many of them, financial ratios fall into four main categories. First category, the profitability ratios. What are they for? Measuring your profits and losses. Why are they useful? To know if your business is profitable and where to act to improve your margins. There are two that are most commonly used. The gross margin shows the proportion of revenue left after direct costs, also called cost of goods sold. This margin is used to cover your selling expenses as well as your general and administrative costs. The standards for this KPI vary depending on the industry in which your business operates. Here is the formula. For example, a business has revenues of $205,000 and, after subtracting the cost of goods sold, $69,000, it ends up with a gross margin of 66.3%. This means that for every $100 in sales, $66.30 is available to cover its indirect costs. The operating margin shows what remains after accounting for all costs. In other words, the profit. Here too, the standards for this KPI vary depending on the industry in which your business operates. Here is the formula. For example, that same business divides its net profit, $25,000, by its total revenues, $205,000, then multiplies the result by 100. The resulting 12.2% means the business keeps $12.20 in profit for every $100 in sales. The second category, the liquidity ratios. Checking if you can pay your upcoming bills. Why are they useful? It's an indicator that shows whether you may be at risk of running out of cash. When a banker or investor evaluates your business, liquidity ratios are almost always part of the measures they use. There are two that are most commonly used. The current ratio shows if you have enough short-term assets to cover your financial obligations. The higher the current ratio, the lower the risk of running out of cash. A ratio above 1 indicates that a business has enough to meet its financial obligations. Here is the formula. For example, a business with $120,000 in assets divided by $70,000 in liabilities gives 1.71. This means it has $1.71 available to pay each dollar of debt. The quick ratio, also called acid test, is the same calculation but excludes inventory, which isn't quickly converted to cash. It gives an immediate liquidity snapshot. Here too, the higher the ratio, the lower the risk that the business will run out of cash. Here is the formula. For example, a business adds up all its current assets, cash, accounts receivable, and short-term investments, and then divides that total by its current liabilities. It ends up with exactly $1 in assets for every dollar of current debt, which means its cash flow leaves no buffer. It can cover its immediate obligations, but with no safety cushion. Third category, financial leverage ratios, measuring your level of debt and your ability to repay both existing and new loans. Why are they useful? To keep your debt under control and negotiate with banks. There are two that are most commonly used. The debt to equity ratio shows what portion of your financing comes from borrowing. Higher ratios indicates that the business relies more on debt than on equity. Here is the formula. For example, a business compares its total debt, $130,000, to its equity, $100,000. The result, 1.3, simply means it relies more on debt. For every dollar invested, it uses $1.30 of debt to finance its operation. The interest coverage ratio shows how many times you can pay your interest expenses with your earnings. Higher ratios are preferable because they indicate that your business can easily repay its debt. Here's the formula. For example, a business divides its earnings by its total interest expenses. It sees that it generates enough profit to cover its interest costs 3.4 times. In other words, its earnings more than cover the cost of its debt, indicating strong ability to meet its financial obligations. The fourth category, the activity or efficiency ratios. What are they for? Assessing the efficiency of your operations. Why are they useful? They show how quickly your production turns into cash. There are three that are most commonly used. The first one, the inventory turnover period, shows how long it takes to sell your inventory. It helps you avoid overordering or letting products gather dust. A shorter inventory turnover period is preferable. It means your funds aren't tied up for long. Here is the formula. For example, a business takes the average value of its inventory, $50,000, and multiplies it by 365 days. It then divides this result by the cost of goods sold of $69,000. The outcome indicates it takes about 264 days to sell its inventory. This is considered a long period, which may signal slow inventory turnover or an inventory level that is too high. Second, the average collection period indicates how quickly your clients pay you. In other words, the average time it takes to receive the cash from your sales. Most businesses want this period to fall between 30 and 45 days, but the standards vary depending on your industry. Here is the formula. For example, a business multiplies the average amount of its accounts receivable, $50,000, by 365 days. It then divides its total by its annual sales of $205,000. The resulting 8.9 days means the business takes, on average, less than 9 days to collect its payments, which is an excellent turnaround time in most industries. Third, the average days payable indicates how long it takes you to pay your suppliers. A longer period lets you hold on to your cash longer and therefore helps finance your operations. But don't overdo it. Delaying too much can strain your relationship with your suppliers. Here is the formula. For example, a business first multiplies the average amount of its accounts payable, $25,000, by 365 days. It then divides this total by the cost of its annual purchases, $200,000. The result means that the business takes, on average, just over 45 days to pay its suppliers, which may be acceptable or even advantageous depending on the negotiated terms and industry practices. Let's recap the concrete benefits of ratios. Ratios help you make better decisions. They give you a clear view to act quickly. They also help prevent risks, so you can anticipate cash flow or debt problems before they happen. Ratios drive improvement and show how to boost efficiency and profitability. And finally, they strengthen your credibility. You can answer confidently your bankers' questions and investors. When should you use ratios? Regularly. Update your ratios every month to track trends. Compare your results to your budget, your industry, and act on any gaps. Many accounting software solutions include ratio calculators. Discover all the free ratio calculators on BDC's website and start optimizing your business performance today. Ratio calculators are much more than accounting tools. They're strategic allies. Don't wait to integrate them into your daily management. Questions or comments? Leave them below. And don't forget to like, share, and subscribe. See you soon for another episode of Ask an Expert.